Good evening. This is Doc Severson for the TheoTrade report for Tuesday, December 5th. We'll start out tonight's report on the S&P 500. Yet again, we have that magic triple exhaustion showing here, where monthly, weekly, and even daily now is in exhaustion, and we're starting to see some reaction at the top here. About time, but finally all the pieces are starting to fall together, where we might start to see a little bit more of a reaction or the price moving into a larger range to trade inside, more two-way tape. This is what we've been waiting for quite some time. I'd say the better part of a year. Now, over the last week or two, I've been talking about the four things that are really sort of necessary ingredients for us to start seeing a market top and a subsequent intermediate reaction. Now, again, my intermediate reaction is going to be disappointing to a lot of people because based on what I'm seeing in a lot of news sources, they're expecting a move down to maybe 1800 again. Well, guys, that's not going to happen. That's never happened before in the past. So unless we have some kind of unbelievable exogenous event that occurs, which trims that much value from the S&P, in which case we probably have bigger issues to worry about anyway. The first reaction normally is a more normal reaction, even though it comes as a shock to everybody that doesn't know anything other than what we've been trading through over the past year. So let's go over those four things again just quickly here. First of all is that there's the four stages of a market rally. First of all, we start with disgust, disbelief as the price rallies back up again. Then we get into the acceptance phase, especially after the election, where people generally accept, yep, the market is going higher. So there's still a certain amount of healthy skepticism, but generally people believe that the conventional wisdom is that the market's going higher. And then finally, it seems like it's taken forever to get to this point, but you can clearly see that now we're getting to the point of euphoria. And not only that, just based on the sentiment that I'm seeing out there, the number of positive articles that we're seeing in newspapers and magazines and online news sources. Anytime you have the bull market as the lead story in something like a Time magazine or Forbes or one of the more general publications like that, usually it's a bad sign or more of a contrarian sign that things are a little overdone. By the same token, we see the same exact thing when those magazines show a bear market in place. Usually it's over by the time that it hits those publications. So this euphoria, which is the fourth stage here, is certainly in place now as we're starting to see what's nearly a vertical rise, just an infinity slope setting up to the upside. So all rise, no run, where this thing is just going straight up like that. And this has been the case for the last few days. So those are the first two ingredients. The third ingredient is what we're looking for is an increase in ATR. So here we go. Here's the chart on the S&P going back over the last 6 years. And you can see, based on what we saw here in October, there's only one other time in the last 6 years we've seen such a low level of realized volatility, or ATR. In this case, average true range, was this rally that we had 2010 into 2011 was extraordinarily quiet, eerily similar to what we have seen recently here. And you can see that what started to happen around here, this is actually the Fukushima plant explosion occurred right around at this point. That starts off the volatility. That starts things moving around. And this is kind of that range that I talked about. And eventually we get the big move. We get the big move, which sets the bottom of the range. So this is all very much a process. Market tops are a process. Everybody that comes into this, especially people that are bearish, look at the news, they look at the fundamentals, they look at the valuations and say, my gosh, this thing is going to be down here at 1600 by tomorrow morning. And it just never works that way. It never works that way, even across some of the worst bear markets that we've ever seen. The worst selling always occurs at the bottom of the move, after the move has already started. So what usually happens with these is that you'll see the move start, and then you see these incredible rallies that show up during a bear. And those eventually will roll over and lead to more selling, and then you'll see another incredible rally again. And then the worst of the selling kicks in at the very bottom of the move, well into, from a time perspective, the bear market. So we're nowhere even close to that. As you can see here again, we have just started to tick up on the ATR. It's starting to sniff some volatility, and that's good. That's a good sign. That means that we're starting to get some more two-way tape. Now, the only thing that we're missing right now is that shot over the bow, that announcement that volatility is here. And so you can see this back in 2011 of this happening. You can see this is the Ebola scare that we had that kick-started the volatility and eventually led to the bottom of that range as well too. And so we'll expect to see something like that in the near future. You can see that the volatility, or ATR in this case, it actually started to increase well before we had that Ebola scare that really served to act as a slingshot for markets. So again, once we do see that initial scare, prices will probably print a new high or very close to it. But the volatility will start to remain much like the ripples in a pond until we finally get that one shot down that scares everybody to death, right? Like this one here back in 2015. And this is all that we're looking for. This is all that I'm looking for, is just an increase in volatility, a larger range to trade from. Again, tops are a process. It's very much a process event. It's a sequence of events that gets kicked off by, first of all, getting into euphoria and then going nearly vertical as we've done recently. And we're starting to fade from that now. We're starting to see the ATR tick up. All these things are good. We'll eventually start to distribute at some point, and we may have to come up to the upside first to create that lower high that gets faded very strongly and really starts to build the fear and the implied volatility that we can use in today's market. Now, you may be saying, well, that's all well and good, but what do we do in the meantime? What do we sell? Call spreads? Do we just short this market? Do we buy puts? What do we do? Well, one of the trades that Don has taught recently is the ratio butterfly. This is a very useful trade around right now, because if we're expecting to see volatility and kind of at least range bound right after this sort of euphoric high recently, then we can play against that. So one of the scans that I have in here is looking for ratio butterflies. And one of the stocks that came up on this was Schwab. So the reason I like Schwab here is I need to take a little bit different view of this. Go over here and look at Schwab. And you can see what Schwab is, it's coming up to one of its all-time highs. And that's going to be more than likely overhead supply, overhead resistance. I don't know that there's necessarily going to be overhead supply back here from 1999, but certainly it serves as a resistance point in the near term, especially as this chart too has gone into exhaustion on the weekly and the daily charts. So it's unlikely to go further to the upside with at least flagging out here in the short term. So what we can do is we can build that ratio butterfly against it. So what I've done here is I've actually created the ratio butterfly. We're using 5 Jan options, and we're going to be going long the 50 strike, going short the 52 strike with 3 contracts, and going long the 54 strike. So the strikes are equidistant, 50, 52, 54. They're just in different quantities. So you might also look at this and say this is a broken wing butterfly. It's essentially the same thing, with the exception that instead of pushing out the distant long, we're keeping all the strikes equidistant. We're just affecting the quantity here. And so this becomes a trade where you can see that the price can still go up to maybe around 53, and we can still profit from this trade. And we get a full credit. So if the trade crashes from here, we just keep the credit. But we're expecting to see the price kind of stay in this range here between 50 to 52, and this gives us a chance to perhaps profit a little bit more than we would had we just looked at taking the credit to the downside. That's just one possible trade. There's other ways to do this as well, with either in-out spreads, in-out put spreads to the downside, or even an out-of-the-money vertical spread as well too. That is it for today's report. Thanks for listening, and we'll see you tomorrow, folks.